What's up, guys? Jeremy here from BR Legacy, here to talk about 2024 as a whole, as well as Q4 specifically. As a reminder, this video is not financial advice. I make this for your education, for your entertainment, to help you understand how I'm seeing things, but not to advise you specifically, though feel free to reach out if you want to have any type of financial advising conversations. That said, let's dive into it. Q4, how do we do? And then let me kind of zoom out a little bit, look at the whole year, and look forward a little bit into 2025. More than anything, though, before I get into it, I just want to say thank you again, and I want to say congratulations again. Thank you for allowing me to serve as your financial advisor. 2024 was a big year for BR Legacy, beginning the year at $1.5 million in assets under management, ending the year at $5.5 million in assets under management. And now getting to move from Arkansas to Houston to be able to move into more full-time, truly full-time BR Legacy work, investment management work. I just want to say thank you so much for trusting me and thank you for the opportunity. And your pins are on the way if they haven't arrived to you already. Those Founders Series BR Legacy nice metal pins with a cartridge replacement as well. They are on the way. Thank you so much. Seriously, guys. And also, congratulations. Congratulations on a great year in particular. 2024 for full year. The weighted average. So every person's different goals. You know, I can't make a prospectus advertising. This is our funds return because every person is different. But if you just took the weighted average of you guys, of my clients in 2024, the overall gain for the year was 97.16%, nearly tripling the S&P 500's 24.89%. So way to go. Congratulations. In Q4 specifically, up 32.76% in the quarter, which, interestingly enough, that Q4 alone beat the S&P 500's full year by a 32% margin, right? That, anyways, I won't dive into the math, but S&P 500 in Q4 only up 2.49%, which is actually a strong quarter, but you beat it by 13 times in Q4. So way to go, way to finish strong. So I wanted to spend some time in this video zooming out a little bit and just answering the question, how do I generate alpha? Or in other words, how do I generate returns that are in excess of the overall market through active management? And this is not just specific to me, but how could anyone hypothetically do this? In other words, how can I just, right for a few minutes, make the case for active management, make the case for this way of operating a portfolio? And I'll break it down into a couple points here, maybe 4 or 5 points. The first one, the most important one, is knowing what to say no to. Now, this for me is huge and usually comes from a values alignment perspective. What are specific companies or what are even maybe industries that from a values perspective you do not feel excited about or even comfortable investing in? And for me, I think about this often. I want to align with the mission of a company. I want to feel good about partnering with them, enabling them, financing them. I get to be a part of building society as we know it through how I invest my dollars and how I invest your dollars. And so there's a lot of companies that I wouldn't want to be on the board of. I wouldn't want to be associated with. I wouldn't want to say, yeah, that's what I helped build. On a specific company example, I feel like I have roasted this company before, so sorry for doubling down. A news article that came out this year from Wells Fargo it happened in August, but I don't know when exactly it got reported. There was an employee who died at her desk, which is incredibly sad. The funny part, or maybe even the sadder part, is that she was not found for 4 days. And the way that she was found, and she was just at her desk, okay? She wasn't hiding. She was at her desk for 4 days. And 4 days later, employees begin complaining about an odor in the building. And that is how she's discovered. I'm like, is this what we have come to? Is this corporate America now? Like, we got to do better than that. And I think it was from a Friday to a late Monday. Okay, there's some weekend in there, and a lot of people are working from home these days. I'm not saying that is like, I would never invest in that company because of this specific story, but it sure is discouraging the bar that we have set as far as values in our workplaces across America. But a specific company example would be like McDonald's. Like, I don't have anything against restaurants. I don't have anything against fast food, but McDonald's specifically, from the research I've done of them, I'm like, I don't really want to be invested in McDonald's. I don't want to be a part owner in McDonald's. An industry-wide example could be tobacco, for example. It would be one for me. I don't want to own tobacco companies. There are other examples that I personally would not want to invest in. You guys know I've talked about corruption in the kind of the large financial services industry. There's also bones I have to pick in the large pharmaceutical industry. There's industries as a whole that I would say, no, I don't want to invest here. And I could avoid some pitfalls that way. There might be some companies that end up going down that I didn't have to suffer with because I decided to remove myself from those companies, even though they maybe are represented in the S&P 500, for example. But you also could totally miss out on some great gains. And the point is, not so much was it a good or bad idea financially to avoid investing in specific companies. The bigger added value is it frees up your space to then look into the companies that you are interested in investing in, to have effective filters by which you can narrow down how many companies are you researching, how many companies are you considering investing in. That's a huge advantage as an active manager, rather than feeling like you need to know deeply each and every company that's publicly traded, because no one could know truly that many companies. So knowing what to say no to is step one. And then there's really three main ways, once you're investing in companies, that you generate alpha as an active manager. One is having overweight positions in specific companies, particularly companies that are at attractive prices based on what their price is now relative to their underlying fundamental value. In Q4, for example, Dutch Bros had a great earnings report, and they went up nearly 70% in the quarter. Honest Company, they had a great earnings that officially turned the company profitable, and their stock more than doubled in Q4 alone. Zoom up 20% in Q4 alone. GameStop up 46% in Q4 alone. These are companies I've talked about in past videos. But as an active manager, you can say, hey, I want to have a concentration here that is larger than the way that it's represented in the S&P 500. Many of these companies are not even included in the S&P 500 currently. And so an awesome way to outperform, if you can project simply or assess based on what the company is reporting, that, hey, the direction of this company is moving towards a significant larger value than what it's currently trading at, that is an awesome opportunity. You can also have overweight positions in specific macro trends. So one that I've been talking about over the past year or two is AI. And AI development really having a chance at leapfrogging a potential impending recession due to its ability, hypothetically, its opportunity to substantially expand global GDP. So even if the relative by household numbers stay stagnant or suffer, the overall production and the overall size of the economy, the amount of money to go around, might increase in spite of maybe some tailwinds on the household financial strength. So within AI, we have concentration in some names. For example, Palantir up 90% in Q4 alone. Meta, Google, Apple, NVIDIA, all up over 10% in the quarter. Tesla up 54% in the quarter. SoundHound, a recent investment that we made in Q3, up 300% in Q4 alone. So AI as a macro trend concentration, certainly benefiting your portfolios. The last way is trading around the peaks and troughs, specifically of concentrated positions during moments of unwarranted volatility. This one's really interesting from an active management perspective because every company has some amount of volatility and every company has moments of news becoming public that can then affect the stock price. And what I need to do as an active manager is discern, does this news impact my value of this company? Does this news impact the reason why I would be invested in this company? And if it does, that might mean you do or don't trade it. And if it doesn't, that might mean you do or don't trade it based on the direction of the price in response to the news. So let me give some specific examples here. So with Tesla, for example, I trimmed in your portfolios, I trimmed Tesla around 250 in July after a pretty substantial run up that followed a Q2 deliveries beat. Now, why would I trim it if they just beat their Q2 deliveries number? Because one, I know that overall the auto industry is the worst performing industry in a recession. And two, Tesla, the long-term value of Tesla for me as an investor is not tied to how many cars can they produce. It is tied to how quickly and how sustainably can they utilize AI, whether primarily through their autonomous driving network and now also their humanoid robots. What is that revenue going to look like and when will that come online? Or you could even argue maybe energy storage as a even more important industry for them than the auto industry. So a huge, 15, 20% climb based on a Q2 deliveries beat when I know, and they're projecting a pretty stagnant full year for deliveries. It's like, great, let's go ahead and trim here. Not day trading, not selling out of the whole position. Let's just trim a little here. And then a month later in August, we were able to buy into Tesla at 200 per share. And it went down to 200 following some weak macroeconomic news. I love buying companies that are affected in a relatively greater than other companies in response to macro news that might not really directly fundamentally impact the future value of this company. I love that opportunity. I love that buying opportunity. So great, we sold at 250, we buy it back at 200. That's what, a 20%, 25% difference in price point right there. And then a month later, we sell it at 250 leading up to their autonomy day. So now we've locked in some of those gains. We're just trimming it. Again, we're not buying and selling the whole position because that would create havoc from a tax perspective. But trimming it at 250 before their autonomous event, because as a close follower of Tesla, an investor for 5 years now, I know that historically they run up in anticipation of these events, but often go down after these events. The Cybertruck was another great example where people are excited to see it and then they see it and they think, oh no, what is Elon Musk doing? He's ruining this company. And autonomy in particular was an opportunity to say, hey, I bet people won't like what Tesla says, because every time Elon talks about autonomy, the stock price usually performs poorly. Often the investor sentiment from Wall Street is, I wish they would just focus on auto margins. I wish they would just focus on production and not be spending so much R&D on something that we don't think is ever going to happen. So that's a great difference to say, okay, I have a different why for how I'm invested in this company than someone else does. For someone else, a deliveries beat is hugely important because they're just valuing the company based on those numbers. Whereas for me, say, hey, I'm really in this for a longer term play, a deliveries beat, not as important. So anyways, selling leading up to the autonomy day, and then buying in a month later in October at 220. So again, a great margin following investors' reactions to Autonomy Day, where they see the cyber cab and they see the robo van, and they're basically, again, like, oh no, this is all about autonomy. The cyber cab doesn't have a steering wheel. The robo van looks like a metro bus. Like, why can't you just make normal cheap cars so that you can sell more cars and more people can buy the cars and make a normal van? And so, again, as a long-term AI investor in Tesla, it's a great buying opportunity. And then the stock more than doubles in November and December. This is following Trump's election. And I'll dive into that in a minute here. But from a fundamental perspective, for me, even though that price difference was a way bigger difference, why would I sell at 250 and then sell at 250 again, and then it goes to 450? Why wouldn't I be selling aggressively? And the reason is because that difference in price is aligned with my why for investing in the company. Not because Trump is some magician, but because he will be in office for 4 years, and that is the window of time where Tesla needs as much regulatory grace as possible. The big monkey on Tesla's back has been regulatory pressure, especially as Elon makes many enemies across various government organizations. It's like, man, who's gonna put the okay on we can let these cars drive autonomously? It's been a little bit of a scary thought to think, what if they have the technology but they're not allowed to use it? Same with their humanoid robot. Who's going to be the person to sign off and say, yeah, you can sell robots to people now? So that regulatory tailwind is huge for this 4-year window in particular, when within this window, Elon aspires to be pushing out both of those products. And so huge fundamental shift in how quickly can this technology really be rolled out. The same thing happens with GameStop. We trimmed it at 30 in November, leading up to earnings. We bought it at 27 in December, following the market's reaction to earnings. It also happens across the two positions. These two in your portfolios right now are the two most highly weighted positions. It happens to lesser extents with some of the others like Zoom, Honest, SoundHound. We've trimmed a little. Marathon, we've gone up and down based on different trends. But GME and Tesla primarily are easy examples. But it happens across positions. So we trimmed Tesla at 440 on December 18th to buy GME at 28 on December 18th. And then we trimmed GME at 31 on January 2nd, just a couple days ago, to buy Tesla at 378 on January 2nd, just a couple days ago. 2 days later, Tesla's back at 415. Now, knowing the whys of all those things, not that important. You probably didn't want to get that into the weeds of it. But that is the other way that we generate alpha, is by trading around those moments of volatility, particularly when those swings don't affect you or don't align with the way that you value the company. Overall, the big picture, my investment thesis, it really just comes down to this simple phrase, which is just be right. If you can pick the right companies, which is not rocket science, okay? I'm not so much smarter than any of you guys, but if you can just be right about a few fundamentally held positions and convictions, then you can see years like this. Every year is not going to be like this, but great year. And I just wanted to spend some time explaining this so that you can feel like a little bit attached to or connected to how did this happen. We're not buying lottery tickets. We're not day trading. We're not risking the farm over some specific, time-sensitive opportunities. We're long-term investors, but we are active managers. And that has worked to your benefit. That said, let's give a little bit of a Tesla update, a little bit of a GameStop update. I always like to give you a little bit of news, if there is any, since these are concentrated positions in your portfolios, to kind of keep you in touch. The main thing with Tesla, I mentioned their Autonomy Day, but they have in their autonomy day, and then in particular their Q3 earnings report, really have rolled out a few new vehicles. A couple of the really most important parts is that Elon Musk, he always has claims. He always says things will be ready next year, but usually it's very vague. And this time he said, in 2025, well, a couple of things he said. In the first half of 2025, we will begin producing the Cybercab, which is the $25,000 robotaxi with no steering wheel. Like, it can only function as a robotaxi. He says we're going to start making it in the first half of this year. So that timeline was much faster than what people anticipated. And then he also offered that they already have regulatory approval essentially in Texas and hopefully soon also in California in 2025, and also, if not more states, in 2025. Of course, more states coming eventually. So again, big move forward on the autonomous timeline. And then he also added that, hey, the Cybercab, the goal is for it to reach 2 million in annual production by the end of 2026. So basically, they are building it fast, ramping it up fast. Energy storage also continues to skyrocket. I mean, it's like doubling and now tripling year over year, and the backlog continuing to grow also. So just a hugely popular product, their battery storage solutions that cities are using. So overall, a very exciting quarter for Tesla. Trump being elected, creating that regulatory runway. So even if it's not this year, it could be next year, or it could be the next year. Like, really, you have 4 years where you've got like the bullseye's right there for you. You have the runway paved for you. So there's even a little bit less pressure on, does it have to be this year? But for him to offer those added details, it's more than just it's coming soon. It really is coming soon. So that's very exciting. They clarified they've also already developed the app, the Tesla ride sharing app, and that internally employees already use it in the Bay Area. So really, really exciting stuff if you take him at his word, or even if you think he's a little bit off. Of course, I'm also in the weeds of, watching people's videos of their drives and hearing the everyday updates that are happening to their full self-driving software. And it does seem like they have had their ChatGPT moment in 2024, huge step up, and then continual step up in the learning process from there in terms of how many interventions are happening, how does it compare to a human driver, etc. GameStop, more of a quiet quarter. One main update from a fundamental perspective, which is that they partnered now with PSA. That is a card grading service. So now you can buy and sell graded cards on GameStop's website and in stores. They also have rolled out their own card grading service, so you can get your ungraded cards graded at GameStop. These are pretty large industries that are growing in popularity. And they also added to their board the CEO of PSA. So pretty substantial partnership that they are building there from a fundamental perspective. Other than that, still continuing to stay lean and mean, still profitable, still closing stores to get to the right size footprint that they need. The other technical analysis or technical update on GME is that they offered up in their Q3 earnings. This is the first time they've said this, which is, we do not plan to sell any shares during the remainder of this fiscal year. GameStop's fiscal year runs through January 31st. So some people have speculated, what if GameStop is signaling that, hey, there might be some nice price appreciation between when they released this, which was mid-December, and January 31st, aka right now, these next 3 weeks. What if something happens? And they're basically potentially letting derivatives traders, options traders, those people, those last minute swing traders, day traders, trying to capitalize on momentum, saying, hey, we're not going to let the steam out of this. We're not going to sell shares into it. So if we see a big spike, feel free to jump on for the ride. Personally, I don't think that necessarily GameStop is signaling that, but it's possible that January is quite exciting for GME. And it's also possible this video becomes outdated before you even, I record a couple days before this makes it to you. And so maybe it's already started. Who knows? I do think, though, it's helpful language that potentially they will begin putting into each of their quarterly reports, which would be very encouraging if you are a believer that, hey, we might see a very dramatic appreciation of GameStop stock price related to all the naked shorts, related to kind of the bets against GameStop coming due. Would that create a short squeeze? That's an exciting piece of language for them to begin including. If it doesn't happen in the immediate term, at least to know with some level of clarity. It doesn't mean they won't sell more shares, but if they continue to say that going into each quarter, hey, we have no plans to sell any more shares, that will continue to build investor confidence for those that are investing purely from the technical perspective. All that said, not that exciting of a quarter, not that much new from GameStop, but all the things we would want to see continue to happen, and we'll see how 2025 goes. All right, let's wrap this up here. 2024, it's going to have some tax implications for you. The only downside of, tripling the performance of the S&P 500 is usually there's some level of ordinary income and long-term gain income that will need to be reported. IBKR will produce that for you. If you want to make any tax moves before you file in light of some additional ordinary income coming from your brokerage, you're welcome to talk to a CPA about it. I do have a financial coaching group if you wanted to consult me on your personal taxes, but I'm not a CPA. I don't file taxes for people. But just let me know if you need anything from me, if you need to withdraw any money from IBKR, if you end up having to pay a one-time tax, whatever it may be. I do try to mitigate as much as possible any tax burdens, but I'm solving for the right portfolio before taxes. In other words, I'm solving for appreciation before taxes. I don't want to try to save a nickel to lose a dollar. If we double in price in your portfolio, and let's say you owe 40% tax on the entire appreciation, and so now we're only up 60% instead of 100%. Well, that's still more than double what the S&P did, so even if you owed zero tax on 24% and you owe 40% tax on 100% growth, you're still much better off for it. And so I don't want you to feel stressed about taxes, but I do want you to be aware that, hey, when you make money, you owe the government money. 2025, still plenty of reason for caution. There's a lot of irrational exuberance related to Trump being president, that he can just save everything and make all the bad go away and make all the good come, and less regulation. That is perfect for an active investor, for an active manager, because I still have your portfolios positioned in light of severe downside risk, which I think is very real. I think it's more real in 2025 than it was in 2024, partially because of the irrational exuberance that is a little bit detached from how much can a president really do. And then also, it's a new year. So in 2024, every month that goes on where the S&P has appreciated, it becomes that much less likely to see a severe recession in that year, because there's so many portfolio managers and big money people that are paid based on profit shares of specific fiscal year performance. And so basically, it's like to see a severe recession start in November or December is hypothetically less likely if they had the ability to kick the can into January, February, March, or April or May, that might be preferred. So at least, hey, this year can be a wash, but maybe we'll be back at it next year, versus this year's been so great, let's not give up the bonus that's coming our way. That's all kind of speculative. That's not that important of a factor, but the underlying reasons, the debt levels, the interest, the wages, far trailing inflation growth, all of that is still super real. People are still in the grind in their personal finances, most people. And so, yeah, there's definitely an opportunity for a Main Street-led recession. And I'm optimizing for either scenario, the boom or the bust. And I do expect some moments of violent volatility, similar to what happened in May this past year with GameStop, where you wake up one day and it's quadruple what it was the day before. And then by the end of the day, it's only double what it was. And oh my gosh, it's high and it's lower, but it's still higher. And I think we will have that, not just in GameStop, but I think there will be moments like that this calendar year. And so just want to prepare you for that. Some of that we could mitigate against, but some of that's just the nature of being invested in the market. There is volatility risk. And I just want you to know that I'm leveraging that to our benefit as best as I can. It's not something that I'm afraid of from a long-term fundamental performance of your portfolio perspective. I definitely encourage you to keep zooming out, keep looking ahead, 5-year windows. Don't get too locked into this moment, that moment, trying to time exactly when this or that event that's so far out of our control might happen. Instead, let's keep locking into who are the companies we're investing in, and let's stay attuned to, are they on pace to do the things that we expect them to be able to do? If so, this is going to work out great in the long run. Let's not get too stressed about the short run. And it might be quite another strong year even if we do have a severe recession, and it might be another strong year market-wide. Either way, I feel really great about how your portfolio is positioned. But I just, particularly after a 2024 that was so lucrative, I do want to keep communicating as best as I can some words of caution. Every year, we are not trying to triple or quadruple the S&P 500. We're just trying to make sound decisions within our own framework for decision making. And I do believe long term that will lead to outperformance. But I don't want you to feel so attached to any particular number on any particular day, as this is the new benchmark. It's a clean slate. Let's see what happens. I'm excited for 2025 regardless. And if you need anything, feel free to reach out. That is all I have for you in this one. The last little tagline is, hey, let me know if there's anything you're wanting from me in BR Legacy as a whole. I am beginning to explore, hey, what could I start doing in 2025? For example, what if I had a little Q&A once a month hosted on YouTube, like any questions, any investment related, like how am I seeing this company, or let's dive into that company, or how am I seeing the macro economy? Like, would you want videos more often? Would you want it to be produced like this, or would you want it to be more live Q&A? Or any other ideas you might have. Certainly feel free to reach out. If there are ways that you feel like, man, if you did this, that would just be awesome. I would super appreciate that. That would be the cherry on top to an already great financial advisor relationship. I would love to hear those things from you. And I will end it here. Thank you guys. Congratulations again. And I'm excited for a new year.